Good morning. Just want to give you a very, very quick update on some things that are happening and try to dispel any issues that might be rolling around. If you're watching mainstream press in any way, you're probably not getting the full story in terms of what's actually going on. I know that there are a number of people who believe right now, based on the current 3-day movement within the Dow, the Nasdaq, the S&P, you name it, global equities, that the bottom's in. And oh my goodness, we're missing out. We're not. I am firmly convinced that this is not yet the bottom. And one of the main reasons why I believe that to be the case is that cross-asset volatility is incredibly, incredibly heightened. It's very, very high. And when I say cross-asset volatility, I'm talking about the volatility indicators that track various volatility regimes. The VIX for equities, the MOVE index for fixed income. Although the MOVE index for fixed income on treasuries is coming down, so the Fed's having some effect, as they should, buying $75 billion a day of treasuries and $50 billion a day of mortgage-backed securities. But nevertheless, high yield, credit, things of that nature are still really elevated, and I'll share a couple of items with you on that in a moment. OIV, which is the volatility indicator for oil, is ridiculous, really through the roof. I think I shared with you a chart in my last video where it typically lives in a very comfortable range somewhere between 20 and 30. We're at 140. That's really high. And gold. So interestingly enough, gold has put itself into a very bullish trend. And so the objective is to buy gold when the spot price of gold comes back down to about 1540. So we're waiting on that before we decide to enter into a long position. We know that the world is incredibly short of dollars, and therefore the demand on dollars is going to be very strong. We're just getting started in the midst of a currency war. We're seeing currencies across the globe continue to what appears to be in a race to the bottom, and we're the world's reserve currency. And so therefore the demand of US dollars is going to increase. And as that happens, we'll see, more likely than not, the position that we're developing in symbol UUP, which represents the US dollar index, go up. And so therefore, we decided to take another quarter position into UUP today. So we're legging into that very carefully, very slowly, very focused in risk management. And so therefore, we're about a 3/4 position currently built into that. And we think that that's going to be just fine. And then on top of that, of course, we've got volatility levels of, as I mentioned, oil very, very high, and of gold continuing to be very, very high. So the thing that we have to remember is that when cross-asset class volatility is incredibly high, we have a very, very limited range of owning anything in the market, right? We don't want to own equities when we're seeing the VIX ratio structured anywhere above 31. We really don't want to own oil with it in the range that it's at 140. We can short oil, and in fact may do that. Interestingly enough, it wouldn't surprise me to see a high to mid-teen handle on oil as we continue to go through this, because there is a supply chain problem due to the virus issue. There is a very serious demand issue coming from that. And so all this stuff is developing for us to take opportunities of a very short-term nature within markets. Yesterday, we decided to take a very, very small short position for some of our more aggressive accounts in the NASDAQ. And we've got a really good fill on that. And so I feel really good that this marketplace is getting ahead of itself and that we likely see another sell-off. We're looking at taking a very small short position in the S&P 500. The top level of our risk range on that was 2601. I'll share with you a screen real quick on the S&P 500 so you can see what I mean. The high level of the S&P 500 so far is 2598. If this thing gets to 2601, then what that does is for us trigger an opportunity to anticipate a fair amount of institutional selling to come in and likely drive that stuff lower. I'm going to share with you a couple of other data points as I go through the last pieces of our explanation here, and it has to do with the unemployment claims. So the first screen I want to share with you here has to do with initial claims of unemployment. Now you might remember the last time I showed you this is down here when it had this small little hook up. And when it was hooking up, what I said is that unemployment claims don't just kind of go up. When it hooks up, it has a tendency to go straight up, as you can see having happened in every single instance previously for our country before we hit some form of a recession. And that was the case here too. This thing went straight up based on the initial jobless claims that were announced this morning, which were way, way higher than anybody estimated. We estimated them to be really high, and they were even above what we thought. Analysts estimated somewhere between 1.64 million in new jobless claims. It came in at like 3.4, 3.5 million. And unfortunately, I think that's probably the beginning of the bubble for that. I can't imagine what might be happening in the very near term here to cause that to come down. We continue to deal with an invisible enemy in this virus. It continues to shut down economies across the globe. And when that happens, you end up getting this thing called a consumption recession. If people are out of jobs and Congress keeps dillying around with whatever they're going to do on the stimulus package, then it just creates an environment where people hunker down. And just like the coronavirus has changed behaviors personally and corporately, the likelihood of those behaviors continuing to change as it relates to spending keeps going up. So let me just share with you a couple more screens before I move on. As I said, this initial claims number is likely to keep going much, much, much higher. So as these claims continue to move forward, we'll just deal with it as we have to, but just know that this is not something that we're likely to see all of a sudden just stop, up in this average range. It's likely to, if I had to guess, go off the charts, unfortunately. A couple other things that I want to share with you here is with regards to history. And one of the things that I have shared with you in the past is what the market did back in September of 2008 through October 7th of 2008. When the stimulus bill was being messed around with. And we might remember back then the Senate rejected the bill here, the market moved up for a few days, and then the floor fell out. Well, that feels a lot like what's happening right now. The the House is dillying around. They can't seem to get to some negotiation. There's some parts of this bill that the Senate decided to pass that frankly, I don't understand. The unemployment benefits that are going to come to some people in some states exceed what the average hourly wages are for those people in that state. And so it's creating, I think, for them, if this bill in its current form gets passed, an incentive to not work, which that's not good. That's not the kind of thing that's going to help businesses, because now if businesses end up having to rehire these individuals, which I'm hopeful that they will, to get back tooled up and get moving and get the demand that's out there replenished and resupplied, well, now they're competing with the U.S. government on wages. And some of these businesses may or may not be able to compete at that level. So that's a little bit frustrating, but it is what it is. And so therefore, if they do decide to compete, what does that do to their bottom line? It restricts it. It creates for them a revenue problem. It creates for them an earnings problem. And so therefore, I'm not sure how we've seen the bottom of the volatility quotient at this point. The next thing that I want to share with you is a picture of net long positioning. Now, the only thing I want to point out is the following. I'm not going to bore you with what a Z-score is. If you want to go look at that, that's great. But the bottom line is that if you see anything heavily over 1 or 2, most likely over 2 in the red, it tells you that that is a thing that someone in the world of major institutional investing doesn't have enough of. And so therefore the likelihood of demand to go up for that thing is pretty good. And so what's heavily red? The US dollar. So what have we done? We've continued to leg into a position of symbol UUP, which represents the US dollar index. We've taken a quarter position over the last few days. We're now up to a 3/4 position in portfolios, and we're going to continue to work on that and keep that in place. And so therefore, it's going to give us an opportunity to experience some demand movements for the U.S. dollar. The world right now, we know, is in the beginning stages of a currency war. Just take a look at global currencies, and what you'd see is many of them in a race to the bottom. And if that's the case, and we being the world's reserve currency, the likelihood for demand of the US dollar continuing to go up is very, very real. Therefore, we want to get in the way of that, and that's why we've bought symbol UUP. The next thing I just want to share with you is this volatility picture. Now, I don't want you to worry about all the crazy numbers. The only thing that I want to focus on is this little section right here. This is something called implied volatility. Whenever you have a heavy negative red number of implied volatility, it means it's a discount, an implied volatility discount. When implied volatility discounts are incredibly heavily red, and we have a very, very high VIX number, like what we have right now, then what we have is an opportunity to see every one of these things that are heavily red go down when we reach the top of a certain range. So for us, the top of a certain range of the S&P 500 was 2601. So let me share a picture with you of the S&P 500 real quick. And you can see today the high of the S&P 500 has been 2598. Now for us, we're being very, very patient and very, very diligent to try and see that 2601 number hit. If it does get hit, and because of the fact that these volatility numbers here are showing us heavy discounts. So for example, the S&P 500 has a implied volatility discount of 26%. If we hit 2601 with VIX being as high as it is, over elevated, that gives us an opportunity to short the S&P 500. And so therefore we're looking at putting on a very small, maximum 3% short position in the VIX. Yesterday, because the NASDAQ hit the top end of our volatility range, again with very heavy implied volatility discounts, we took a very small short position in the NASDAQ, but that was only for some of our more aggressive accounts or those that are in the top end of the moderate type portfolio. And we believe that those are going to pay off simply because I in no way believe that this equity rout is over. I do not believe that we've seen the bottom of this stock market. And one of the main reasons why I believe that's the case is there are still too many people that are too bullish, as identified by the movement in the equity market over the last 3 days. I can tell you that on the margins, those who are major institutions and understand what's going on economically are selling into this particular rally. And that's going to continue for the foreseeable future until it rolls out. The last couple things I want to share with you is this MOVE index. You can see here that the high yield corporates and the BBB rated U.S. corporates are continuing to move up in the MOVE index. What does that mean? It just means the volatility keeps getting higher. And when volatility on those elements are getting higher, what it keeps telling us is that we are in the midst of a corporate debt bubble unwinding. That doesn't happen overnight, and it doesn't happen in a month. It takes some time. It creates capital dislocation. It creates a scenario where major institutions and levered long hedge funds have to sell what they want, or excuse me, what they can, not what they want, to cover the garbage that's sitting in their portfolios. And they still have a lot of it. So we just want to recognize that when these volatility numbers are as high as they are, we're not going to see the likelihood of them come down in the near term. So here are the things we continue to do. We continue to increase our position in the US dollar through symbol UUP. We are looking at buying into treasuries one more time, probably for a little bit longer hold as the MOVE index or the volatility index is getting squeezed or coming down because the Fed is buying $75 billion a day of U.S. treasuries. So our trigger point on buying U.S. treasuries is if we see 1.16% on the 10-year yield. If that happens, we'll enter into a long-term treasury holding. We'll continue to look at buying gold, but I need to see the spot price of gold get down to about $15.40. If we do that, then we'll start to enter into a position on gold. And we continue to look for short-term opportunities in shorting the two major indexes that I believe the excesses are massive in, as identified by those implied volatility premiums, or excuse me, discounts, implied volatility discounts that I showed you on that very busy chart. So as we do that, it'll provide us an opportunity for some short-term gains while the whole world gets excited over a stock market that is going up over the last few days. I don't believe it. I don't trust it. The volatility numbers are not suggesting that they can be truthful, and so therefore we're not going to play that game. So that's that. If you have any questions, as always, give me a call, 608-354-1977. Email chris@careformywealth.com. Continue to want to thank you for the opportunity to serve you and work for you. I'm continuing to hope and pray that you guys are healthy and safe, and that you're not going stir crazy in this stay-at-home kind of environment. Good opportunity to reconnect with your family in instances like this, or at least find ways not to go crazy with each other. So that being said, hope you have an amazing day. God bless. See you soon.